For most of modern history, if you asked someone what it took to build a stable life, the answer sounded simple. Get an education, work full-time, don't spend recklessly, save when you can. Follow those rules long enough, and eventually the numbers start working in your favor. That story shaped the financial expectations of generations. And yet right now, millions of people who followed that exact formula are quietly discovering something unsettling. The math no longer works the way it used to. Across the United States and much of the developed world, household surveys show the same strange contradiction repeating itself. People with steady jobs, degrees, and carefully managed budgets are reporting rising financial stress even when their incomes are technically higher than they were 5 or 10 years ago. According to data from the Federal Reserve's Survey of Household Economics and Decision-Making, a growing share of working adults say they struggle to cover an unexpected $400 expense. Not because they are unemployed, not because they are spending irresponsibly, but because the margin between what life costs and what they earn has been shrinking in ways most traditional economic statistics don't fully capture. Official inflation numbers often hover around 2 or 3% in normal years. On paper, that sounds manageable, the kind of slow increase people can adapt to over time. But those averages are built from a basket of goods that doesn't always reflect the categories absorbing the largest portions of real household budgets. Housing, healthcare, childcare, insurance, and education, the expenses families cannot easily avoid, have been rising much faster than the headline number suggests. When economists isolate these essential categories, the cost pressures start looking very different from the calm picture painted by the overall inflation rate. What makes this moment uniquely frustrating is that many families are already doing exactly what financial advice has told them to do for decades. They track their spending. They cut discretionary purchases. They cook at home instead of eating out. They delay vacations. They compare insurance plans. They refinance loans. They do everything that responsible people are supposed to do. And still, at the end of the month, the account balance keeps drifting towards zero faster than expected. Psychologists who study financial stress have observed something interesting about situations like this. When people feel that hard work and discipline are no longer producing stability, the emotional reaction isn't just anxiety, it's confusion. Humans are wired to search for cause and effect. If something is going wrong financially, the assumption is usually that a mistake must have been made somewhere along the way. Maybe they overspent, maybe they didn't plan well enough, maybe they made a bad career choice years earlier. But what if the explanation isn't a personal mistake at all? What if the underlying cost of maintaining a normal middle-class life has changed so dramatically that even careful households are now running into the same invisible wall? Over the last decade, several structural shifts have quietly reshaped the economics of everyday life. Housing prices have grown far faster than wages. Childcare has become one of the largest expenses in a working household. Student debt has followed people decades into adulthood. Healthcare costs have continued rising at multiples of wage growth. Companies have perfected subtle fee structures that add thousands to annual spending, and automation has changed the way income opportunities grow in the labor market. Individually, each of these pressures might seem manageable. Together, they create a pattern that is much harder to see while you're living inside it. A pattern where families can follow every rule they were given and still feel like they're slowly falling behind. And once you start looking closely at the numbers, a different picture begins to emerge. One that raises a difficult question about the modern economy. If the costs rising fastest are the ones people have the least ability to avoid, can we still honestly say the problem is how people are managing their money? Because the story most people have been told about financial struggle assumes something simple. If you budget carefully enough, the system eventually rewards you. But what happens when the system itself quietly changes the math? The numbers look ordinary at first. 2 working adults, both with stable careers, both doing exactly what they were told growing up would lead to stability. Marcus is a high school teacher. Jennifer is a physical therapist. They're in their mid-30s, with 2 young kids, living in a mid-sized American city. Not New York, not San Francisco, not one of the ultra-expensive coastal markets that dominate headlines about the cost of living. Together, they earn about $91,000 a year before taxes. For decades, that level of income would have comfortably placed a family in the middle class. The assumption most people make when they hear that number is simple. They should be doing okay. After taxes and payroll deductions, their monthly take-home pay is roughly $6,100. On paper, that still sounds workable. A $6,000 monthly income feels like enough for a normal life if you're reasonably careful with money. And Marcus and Jennifer are careful. They don't spend weekends browsing luxury stores or booking spontaneous vacations. Their lifestyle isn't extravagant. It's ordinary in the most literal sense of the word. The kind of life millions of families quietly maintain every day. But when the numbers start lining up on the page, the calm picture begins to shift. Their rent for a modest two-bedroom apartment comes to about $2,250 a month. Not a luxury building, not a trendy downtown neighborhood, just a clean, safe place close enough to work and school to make daily life manageable. Housing alone already consumes more than a third of their take-home income. But finding something significantly cheaper in the area would mean longer commutes, fewer childcare options, and schools that don't always meet their needs. So they stay. Groceries for a household of 4 average around $1,050 a month. That number surprises people until they remember that food prices have steadily climbed over the past several years, especially for fresh items families rely on daily. They cook most meals at home. Eating out is rare. This is simply the cost of feeding 4 people a reasonably balanced diet. Health insurance through Jennifer's employer costs about $1,120 each month for the family plan. That payment doesn't cover every medical expense. There are still deductibles, co-pays and out-of-pocket costs if someone actually needs treatment, but skipping coverage isn't an option. One unexpected hospital visit without insurance could financially devastate a family for years. Then comes the expense that quietly shocks almost every new parent in the modern workforce: childcare. With 2 young children in a licensed full-time daycare program, Marcus and Jennifer pay around $2,250 a month. It's not optional. Without childcare, one of them would have to leave the workforce entirely, which would eliminate an income far larger than the daycare bill itself. Transportation adds another $640 each month. That includes a modest car payment, insurance, fuel, and routine maintenance. In many mid-sized cities, public transportation simply isn't robust enough for 2 working adults managing school schedules, daycare pickups, and full-time jobs. A vehicle becomes less of a luxury and more of a requirement. Utilities and internet add about $270. Nothing unusual there. Electricity, water, heating, and the internet connection that allows both work and school communication to function in the modern world. Finally, there are the student loans. Marcus and Jennifer both went to college because every authority figure in their lives told them the same thing: higher education would open doors to stable careers. Today, their combined loan payments come to about $460 per month. When you add everything together, the result is startling in its simplicity. Housing, $2,250. Groceries, $1,050. Health insurance, $1,120. Transportation, $640. Utilities and internet, $270. Student loans, $460. Total fixed monthly expenses, roughly $7,740. Monthly take-home income, $6,100. Before anyone in the household goes to the doctor, before a car repair, before school supplies, birthdays, clothing, or the countless unpredictable expenses that appear in any real family life. Marcus and Jennifer are already running a deficit of about $1,640 every month. That number changes the entire emotional meaning of the budget. Because when people hear that someone is struggling financially, the immediate assumption is that there must be discretionary spending somewhere: restaurant bills, expensive electronics, impulse purchases. But in this case, there's nothing extravagant to cut. Every dollar is already allocated to the basic functions required to keep the household running. This is where the modern financial story begins to diverge from the one previous generations were taught. In the older version of the system, budgeting was a path towards stability. If your income exceeded your expenses, the extra money gradually built savings, investments, and eventually wealth. The discipline of managing money created breathing room over time. But when essential costs consistently exceed income, the psychology of budgeting changes completely. The goal is no longer building wealth. The goal becomes survival, simply making it to the next month without something breaking. And this is exactly where the modern financial system quietly offers its solution. Credit. The deficit doesn't disappear, it gets temporarily covered. A credit card handles a portion of the gap in October. A short-term financing plan pays for a broken appliance in February. Maybe a small personal loan consolidates several balances later in the year. None of those decisions are irrational. In fact, they're often the most responsible options available in the moment. Missing rent, skipping insurance, or pulling a child out of daycare would cause far greater problems. But every borrowed dollar carries an invisible passenger into the future. Interest. Once that interest becomes part of the monthly budget, the next month starts with slightly less breathing room than the one before it. The deficit grows quietly sometimes by only a few $100s at a time. But the direction is consistent. This pattern isn't unique to one family. Versions of it are unfolding across millions of households with stable jobs and careful spending habits. The individual numbers change, but the structure remains the same. Essential costs rising faster than income, small monthly gaps filled with credit, and the slow accumulation of financial pressure that doesn't appear dramatic in any single moment, but becomes overwhelming over time. And when that happens across an entire generation, the question stops being about individual choices. It becomes about the structure of the economy itself. Because if families who follow every rule still can't make the numbers work, something deeper must be shifting underneath the system they were told to trust. And the first place that shift becomes impossible to ignore is housing, the foundation of financial stability for generations. And the one piece of the economic puzzle that has changed more dramatically than almost anything else. For most of the 20th century, housing wasn't just another monthly bill, it was the cornerstone of financial security. The basic promise behind it was simple and powerful. If you worked steadily and managed your money responsibly, you could eventually buy a home. And once you owned that home, something remarkable began to happen. Every monthly payment wasn't just an expense, it was slowly turning into an asset. Over time, that house would build equity, rise in value, and eventually become the largest piece of wealth most families ever owned. That model shaped the financial trajectory of generations. It's how millions of middle-class households built retirement savings without even thinking of it that way. A home wasn't just shelter, it was a long-term wealth machine quietly working in the background of everyday life. But the math behind that system depended on one critical relationship staying stable. The price of homes compared to the income people earned. For decades, that relationship held. In the mid-1980s, the median home price in the United States was roughly 3 to 4 times the median household income. That ratio is one of the simplest ways economists measure housing affordability. If the average household earns $50,000 and the typical home costs around $175,000, the path to ownership remains challenging but achievable. With savings, steady employment, and access to a mortgage, the numbers eventually line up. For much of the post-World War II era, that ratio hovered within a similar range. Housing costs rose, incomes rose, and the balance between them remained relatively intact. Then something began to change. Over the last 2 decades, and especially after the pandemic housing surge of the early 2020s, home prices began rising much faster than wages. By the mid-2020s, the typical home price in many parts of the United States reached 7 to 9 times the median household income. And in some large metropolitan areas, the ratio climbed even higher. That shift fundamentally alters the meaning of homeownership. A system that once required 3 or 4 years of income to purchase the average home now often demands nearly a decade's worth of earnings. And that's before considering interest rates. Mortgage rates, which spent much of the 2010s historically low, began climbing again during the inflationary period that followed the pandemic. Even small increases in interest rates dramatically affect monthly payments on large loans. A house that seemed barely affordable at a 3% mortgage rate becomes far more difficult to manage at 6 or 7%. So what happens when ownership drifts further out of reach? People rent longer. At first glance, renting seems like a neutral alternative. After all, everyone needs a place to live, and renting provides flexibility. But from a financial perspective, renting behaves very differently from owning. Every rent payment is purely consumption. The money leaves the household and never returns. There's no equity building quietly in the background, no appreciating asset slowly increasing net worth. It's simply the cost of maintaining shelter month after month. And when millions of households remain renters for longer portions of their lives, the long-term effects begin to compound. The people who already own properties see their wealth grow automatically as home values rise. Meanwhile, the people trying to enter the market find themselves spending larger portions of their income just maintaining housing without gaining any ownership stake. The gap between those two groups widens year after year, often without anyone consciously noticing it happening. The famous financial guideline that many people still hear today, the idea that housing should cost no more than 30% of your income, was developed in a very different economic environment. That benchmark emerged when homes cost roughly 3 times the average household income, not 7 or 9. The rule assumed a housing market that simply doesn't exist anymore. Yet the rule remains in financial advice books and budgeting apps as if the underlying math never changed. For families like Marcus and Jennifer, this creates a quiet trap. Buying a home may require a down payment that takes years to save while already paying high rent. At the same time, the longer they rent, the harder it becomes to accumulate that savings, because so much of their income is already going toward housing costs. It's a financial treadmill that moves slightly faster every year. And housing doesn't exist in isolation. In fact, the pressure it creates becomes far more intense when combined with another pair of expenses that many households face at exactly the same stage of life. Because the same years when people are trying to establish careers and think about buying homes are also the years when 2 other bills often arrive at the same time: childcare and student loan payments. One is the cost of building a family in the present. The other is the financial echo of a decision made nearly 2 decades earlier. And together they create one of the most difficult financial balancing acts modern households face. A double bind that pulls money from both directions at once.